All right, testing, testing. All right, guys, good afternoon. Welcome aboard to the aftermarket recap. My name is Carlos Garcia, founder and CEO of G.A.R Capital. It is 5 p.m. Eastern Standard Time, June 23rd, 2022. Let's go ahead and rock and roll. Dow closed up 194 points. NASDAQ up 1.62% today. S&P up nearly 1%, 37.95. We did crack 3,800 on S&P futures, got as high as 3,805. That was a level I was definitely focused on. We'll go over that here in a second. Let me go ahead and expand this for you guys. VIX did come in a little green. It is holding on to that 28.95 200-day moving average level. Slightly green, but again, holding on. That's pretty much the last stand right now for the VIX, volatility index or the fear gauge. If that does break, I expect us to get to at least 27.74, if not around 28, which would push the S&P higher. Yes, I have been saying it for a while. I do expect us to go higher. Again, we have some gaps to fill. We have that inverse head and shoulders. We actually had an inverse head and shoulders today. We went a little higher, and then we ended up green for the day. Mostly futures did the work for the market this morning. Taking a look at small caps, up 1.20% today. Dollar index was green, up 0.19%. Let's go and take a look at that. Dollar index has been pretty much choppy the last couple of days, 105 being that ceiling, like I've been saying, 104 being that support. Again, I'm seeing a lot of things here in terms of tightening. We're seeing a lot of coiling. Take a look at S&P futures. Coiling here the last couple of days. Again, we're getting 3740 to 3800. That range is getting tighter. What does that mean? That means a big move is coming. Look at what happened the last time towards the end of May, close to end of May to beginning of June. I'm sorry. You had like 4185, 4200 being that resistance. We had a triple bottom. We kept knocking on the door, and then we got higher, and then we fell. Now, could that happen today? Sure. I mean, tomorrow, sure. I still say that we're going to go higher. We have that inverse head and shoulders. We have gaps to fill to the upside. And again, we talked about that downward channel in terms of S&P. If you haven't seen that, feel free to take a look on Instagram. That way we talk about it. So again, I do expect higher. We should test right around 38.32 to 38.41. If we break above that, that's just gravy. If not, then we're just going to stay around that level. That's what I would probably be unwinding some short-term positions in terms of being long. If you want to take some profit, I have some options that are expiring tomorrow. So a gap fill tomorrow would definitely be what the doctor ordered and what I expect. Let's go ahead and take a look at bonds today. Bonds were bid today nicely, still holding on to that 50-day moving average, that purple line on the hourly. You could see it's been holding that. Breaking out here, again, kind of this range of around 113 to around 110. Really, the question is, do we get to 116? 116 is that big, big level to go by. I do expect bonds to continue getting more and more bid. Again, you can see HYG, this is high yield credit, up 0.72%. Finally, seeing some bids there. Investment grade, seeing some bids as well, 0.77. Gold was sold a little bit today, 0.61% of the downside. Silver up, down to nearly 2%. Let's go and take a look at bond yields. TNX, this is your 30-year. And all we did was recheck that 200-day. And again, I've been saying that 3% level, that big psychological level we need to get to. We still have a gap to fill right around 29.73. I think we get there. Should be by tomorrow, if not by Monday. Again, I expect a risk-on movement tomorrow. I don't see a lot of economic news that could derail it in terms of headwinds for the S&P. Again, you have Bullard speaking tomorrow at 7:30 in the morning. So again, that's futures. We have revised University of Michigan consumer sentiment. We're expecting the worst anyways, and the home sales that are coming in tomorrow. And we also have revised University of Michigan inflation expectations. I think already the bad news is kind of already baked in. We already know things are bad. At least oil prices are coming down somewhat. So again, I expect at least somewhat of a reprieve at the pump. Look at Bitcoin up today, 3.45% on futures. Ethereum, 1,130, up 6%. So the altcoins were getting some love. And again, I've been talking about Bitcoin being kind of that whisper, kind of that asset that we look at that's kind of giving us a guide to the Qs or the S&P futures. So let's go ahead and take a look at that. We're going to go ahead and add it. We'll go ahead and add QQQ. Now, again, QQQ does not trade 24 hours a day, 7 days a week, the way Bitcoin does. But again, you could see pretty much down to the T. White line is your Bitcoin, blue line is your QQQ. And we're kind of just stuck here, kind of coupling here, which is nice. So again, as long as Bitcoin continues to grind higher, 24-hour trading, Again, still liquid if you have a broker that allows you to do withdrawals, I guess. There was another one that had issues. But again, that's kind of telling us the tale because Bitcoin is a big time risk on asset. And we know Qs are just focused on growth technology companies, right? The top 100 of NASDAQ. Well, with that being said, if Bitcoin does go higher, let's say overnight or tomorrow or over the weekend, Qs are going to go ahead and go with it. So again, I think it's important to keep an eye on this coupling or this positive connotation or this positive correlation, excuse me, and then we can go ahead and see exactly where we go from there. So I like to look at a tick chart when it comes to Bitcoin. I want to see what's happening as it's happening. That's what I like to see there. All right, now we're going to go into, so we're going to go into S&P futures, and we talked about that tightening range, right? So again, 3805 is a key level to go by. I'm going to go and place an alert. Maybe overnight we get it. I have futures running as well, long on S&P futures. Really, the only stop I have here in terms of continuing higher, I think we go to 4,000, but 3043 seems to be the level. Let's go over some headlines quickly. Federal FDX, which is FedEx, did report today their earnings. $6.87 EPS matched estimates. Revenue 24.4 billion, estimated 24.57 billion. That was a little lighter than expectations on the revenue side, anyways. But the key here was the guidance. The guidance of 2023 EPS. Again, we've been kind of looking for that shoe to drop. Again, what's the next shoe to drop, right? Again, we know inflation's high. We know we're getting interest rates higher. But what's that next shoe to drop? Again, if we get EPS revisions to the downside for earnings in terms of these big companies, then we would expect that lower leg to make possibly 3,500, 3,400. But again, FedEx does report later than earlier before than anyone later than everyone else. So again, their time is a little different. But again, it's good to see that their fiscal year guidance was $22.50 to $24.50, $24.50 a share. Estimated was $22.36 a share in terms of the guidance. That's EPS, earnings per share. Sees their 2023 capex at 6.8 billion. This is capital expenditures. The estimate was 6.88 billion. So we know that they increased the dividend. They're also doing stock buybacks. Here is the result of that. FedEx popped to 242. Now it's at 233. So again, up about $5. Was a lot higher. So let's see how the analysts take a look at it tomorrow morning with FedEx. Maybe we get some upgrades or so. Other than that, the only other thing that stood out was the Fed. The Fed says that all banks it examined passed this year's stress test. So I don't know how many banks they tested, but here's XLF. Again, not much reaction towards it. But again, I want to see how the banks react when we have full market open tomorrow. We got some gaps to fill on XLF. There's one right here at 3181. Again, if this goes down because of the stress test, I don't know any other news that they want. Again, the annual bank stress test, all banks tested remained above their minimum capital requirements. So the Fed says total hypothetical losses driven by more than a $450 billion in loan losses and $100 billion in trading and counterparty losses. So stress tests, we've been doing that since 2009, 2008 due to the crash. And again, it's the idea just to make sure that the banks have the proper capital requirements in terms of running a bank. So that should be positive news. I expect us to go higher on that, but nothing right now as of yet. Right now, as futures are closed, again, we get that reopening right around 6 p.m. All right, let's answer some questions. Thoughts on Tesla split? I mean, it's not the first time they've done it. Do I think anything special of the split? No. I mean, it'll probably run up the way Amazon did when they had their split. If you guys remember, it went up to 128, then we came back down, and now we're kind of carving back our way up. So I would expect Tesla to do the same. I expect that Google to do the same, or Alphabet. And that's what I'm seeing in terms of the market in regards to, let me go and remove this, in regards to share splitting. Let's see. Hey, Carlos, thoughts on calls for SPY and Apple? Those are the ones I have as well. Let's take a look at SPY on the hourly. And again, I do expect us to go higher. You could see the ascending triangle. Here's your resistance, 379.59. We should be able to crack that above 380 and get us right up to 382.14. I think that's where we go tomorrow. Again, you could see we're tightening, creating a base. Again, as the ranges get tighter, you're going to get some kind of move, either explosive up or down, right? Kind of easy, right? A coin flip. The idea is getting it actually right. So I expect us to go higher. And I'm just going to go ahead and bring up the same chart again. Let's see if I can bring it up on Bloomberg. Here's the SPX downward channel chart. Once again, here we go. And again, the downward channel, you could see that bounce right off this trend line. And then again, still a target is 4,000. So I do expect, I still want to stay long, obviously. And we just need that little break. We had that break today, 38.05. I thought we would continue, but it kind of sputtered towards the end of the day. In regards to Apple, let's see here. Apple is at 137.93. And again, you have that 200-day overhead. We should break that as well. Probably get to around 140. That's what I see anyways. Thanks, Carmen. Drew says, I recall you saying a recession won't happen. Obviously, that's far from the truth now. Think still that. Well, my man, technically, we're not in a recession, per se. You need 2 consecutive quarters of GDP. So technically, I'm still right. Like it matters. Do I think we have a recession? No, I still don't. Not with this labor market being so strong. Netflix did say there are going to be some layoffs. As we know, JPM is doing some layoffs. But again, when you have the employment where it is now, the labor force, if we had a recession, it'd more likely be a mild one, in my opinion. That's just me. I don't think we have a depression or a crash whatsoever. It's just the labor market is too strong. It just is. What if we start getting supply chains back up? What if crude oil prices go down like they've been doing it? What if we start getting the $70 a barrel oil? Would that counteract inflationary pressures? Would a recession be avoided? That's a lot of great things to happen. But let's see what we get. But we're not in a recession as of yet. And no, I don't think we will, personally. Just out of curiosity, why did G.A.R Capital stop Forex trading? We still are Forex trading. It's just options were just the better route to go from 9:30 to 4. Much easier on the eyes. But yes, we still trade Forex. Yes, we do. It's just not something that's very popular, if I may be honest. But yeah, either way. So with that being said, again, bring up S&P. Really is what we're looking at here is a base forming between June 12th and June 23rd. Question is, do we go ahead and break above 38.05 and sustain above so we can start filling these gaps upward? And again, these are 2 gaps on S&P cash, which is right around 39.01 and then right here out on 40.24. But I would close out at 4,000 anyways. And then after that, yeah, we could definitely get a rollover. Again, so many factors in play. We just have to wait and see. It's all data dependent. In terms of Levi, belligerent's asking. Levi is trading at 1674. Again, just going by technicals. Let me go and take a look at some of their numbers. Well, it's trading at 11 PE ratio. That's not bad. It does pay a 2.39% yield. So again, it really depends what you're looking for, belligerent. Are you looking for, something that's long term? Are you looking to trade it? Because if you're looking to trade, there's some gaps there that you can take a look at in terms of Levi. There's one right at $17.98, $18, and you're right at 1674. Could be something worth trading, sure. I don't think there's much options volume onto it, but again, it's a wait and see approach. What I want to personally buy Levi here, not really. The only apparel company I would probably want to own is really Nike. Nike and Louis Vuitton, Moet Hennessy. They both pay a dividend, granted a little less than Levi, but in terms of apparel, that's pretty much the only 2 I like. I like Burlington as well, but again, supply chains are going to hurt it. They're going to hurt all apparel across the board. Well, consumer's not strong, not at all. It hasn't been proven, so what is stopping us from a recession? Well, Drew, at the end of the day, I did say it was the labor market. That's too strong right now. Again, if the labor market does pull back, we just had unemployment claims, wasn't even that a drop in the bucket, to be honest. If you're talking about this consumer not being strong, I mean, they are spending. The question is, what are they spending it on? Is it more going to be fuel costs? Is it going to be more food and grocery? Of course, obviously. But in terms of the consumer being strong, I mean, it depends on the view you're talking about. Are we talking about pure discretionary? I think what we've been seeing is a shift from travel to leisure to doing stuff as we see that fuel, more people are traveling than buying stuff. Again, we saw the inventory issues with Target and Walmart. So again, I think it's more of a paradigm shift of spending than it is spending is weak. That's all. Layoffs right now, what? Have you seen the mass layoffs across these big companies? Yeah, Drew, that's a blanket statement. What is the big companies that you're seeing layoffs? Let's just go by the top 5 largest by market cap. Okay, we have Apple. I haven't heard any layoffs. Tesla's laying off 10%. Amazon, I haven't seen any layoffs. Google, not yet. Meta is, but they're not a top 5 anymore. Berkshire isn't, and Microsoft isn't. Adobe's actually hiring people. So I think what you're getting is a mixed bag. And usually when you start seeing kind of the shift in between the strongest companies and the weaker ones, and you start seeing more and more acquisitions, usually that's an indication where bottoming out comes in. But again, if you have the idea already that a recession's coming, then you should prepare for it. Absolutely. I just don't think that's the case. Again, the stock market is not the economy either, and the economy is not the stock market. Yes, are we going to raise interest rates? We have already. I think the market is forward pricing everything, pretty much the worst case scenarios across the board. And again, the stock market is ahead of the game. So is the bond market ahead of stocks. More people say that's the smart money, right? Well, if that's the case, let's go ahead and take a look at the 2-year note today. So here's the 2-year note versus the 3-year. This is 2-year versus 10-year. So the red is your 10-year and the white is your 2-year. So again, if let's say if inflation expectations were higher, why would bonds be bid now? Doesn't make a lot of sense because you don't want to lock in a lower rate, right? Again, especially if you're trying to get yield. So again, seeing bonds roll over, again, it could be just technical right now. But for what I'm seeing, again, I still think that equity is going to go higher. Bond prices are going to firm up. Yields will come down. Again, a temporary reprieve. But in terms of a full blown recession, where again, give me a comparison, another recession. Technically, we had one in 2020, right? I don't think we'll get to COVID recession or COVID depression. The last recession before that was not even 2018 when we had raising rates, and then we bounced back pretty quickly. That was just a stock market drop, bear market, not exactly recession. Before that, 2008, that's pretty much the last times. If we can kind of compare of this recession talk to what era, depends on which one. It depends on which era you're talking about. This kind of fits the 1982 analog, maybe a little closer to 1994 if that's the case. We were just coming out of a recession too. Again, I still think a lot of data needs to come in. Again, if we get a softer than expected CPI or PPI data one of these days, there you go. Then things could change. I think a lot of it's optics. I think a lot of it is kind of looking at the worst possible scenario, in my opinion, when it comes to the market. The thing is not comparable to any other year. The thing is its own thing. We've been in the largest bubble ever the past decade. But if that's the case, then why didn't we go lower during COVID? If it was just the Fed injecting capital, then what's to stop the Fed to do it again if we fall past levels that they feel comfortable with? Again, I understand the perspective of a recession coming. I get that. And I'm not saying it's impossible. I'm just saying I don't think it's probable with a strong labor market. And we just had unemployment claims today, and they weren't anything out of this world. NFP actually gained jobs last month. So again, unless we start seeing again layoffs, well, there's more job openings according to the JOLTS reports than there is people. There's 2 jobs for every 1 person. So if you get a layoff, again, what's to stop that person to go in for work for another place? I mean, really, the only places I see or I've read in terms of big layoffs or mass layoffs has really been technology. I haven't seen any other industry. I mean, look at the aviation industry. United, Delta are scrambling to hire pilots and people to help. They're actually short staffed. So again, you got to have a balance of labor. You know, this is a new world, 2020, post 2020 COVID, where people are working from home. The Great Resignation, people call it. People are jumping from job to job to find the best wages. That's the deal. So I think again, still need a lot of data to go, but in terms of recession, we are not there yet technically. If you feel that it's a recession, that's completely different and completely justifiable, but we're just not there yet. And we have a lot of data to go. And again, we get CPI, PPI, we start seeing we already see the University of Michigan consumer sentiment at all-time lows. So I can understand why people saying recession is for sure. Yeah, of course, I get it. All right, guys, we'll go ahead and leave it there. Have a great rest of your afternoon, and we'll catch you guys later for the morning note tomorrow, 9 a.m. Cheers.